So our presentation is on Baskin Robbins. Baskin Robbins is an ice cream parlor franchise that is based on staying true to its neighborhood values. Baskin Robbins was founded in 1945 in Glendale, California by brothers-in-law Irvin Robbins and Burton Baskin. For our project, we created a cost-benefit analysis to see if opening a Baskin Robbins franchise would be worth the time and effort. For this analysis, our payback is 9 years. And onto the intangibles. So for our intangibles for this project, we thought that franchise rights and fees would be one, trade names, health trends, a location. Ordering systems are also just very difficult to train employees with. So that's one, training and operating. Employees getting employees, having them possibly be unprofessional or very young. Product freshness and product waste. Keeping all of the product, but also making sure that the product is fresh, obviously. And then we would also have to deal with mandatory changes from corporate that would include remodeling, brand standards, different flavors like seasonal flavors and things like that. Others would be seasonal business. Obviously, it's an ice cream shop, so winter month sales would be completely different from summer month sales. And then obviously the employee turnover, where we would have issues due to young and unprofessional employees, and then also opportunity costs, which would come with time and investment.
So next we'll talk about the assumptions that we used in our cost benefit analysis. All of our assumptions, besides the weighted average cost of capital, were achieved from an online document containing Baskin-Robbins official franchisee costs and recommendations. And we also contacted a local Baskin-Robbins franchisee owner, and we looked at their financial documents to determine most of these, comparing them to the online website. So for annual sales, mainly these were achieved from the financial documents we got. For the base case, we saw 360,000. For the best case, 419,000. And in the worst case, the franchise owner would be making 301,000 in revenue. The growth in sales we determined would be 2.5% throughout the years. The total startup costs are shown down here, which would be 438,350 as an initial payment. The operating costs throughout the year would be 54,971 each year, as shown below in this chart. The cost of growth or cost of goods sold as a percentage of revenue is 25%. So for every dollar of revenue, the cost of goods sold are going to be 25%. The bank fees as a percentage of revenue would be 2.5%. As a franchise owner at Baskin-Robbins, the ones we interviewed, we found that they only had one full-time employee as the general manager, and they were receiving a salary of $36,000 a year, while everyone else was a part-time employee who would start out at $12 an hour, typically working 25 hours a week, which is $14,400 a year. When looking at our salary inflation, we chose 5%, and we kept this 5% throughout the entire cost benefit analysis. So salary would be inflated every single year without a cap. There were typically 4 part-time employees per franchise location. Royalties and advertisement as a percentage of revenue were 10.9%. And the weighted average cost of capital was the recommendation from the professor for franchises, which was 5%. And the payback period we chose when it would be acceptable was 9 years. To summarize our results, we found that the base and the best case would bring net profit returns after 7.84 and 4.58 years respectively. And in the worst case, we found that you would never make profitable returns. The break even was calculated with 9 years in regard. So how long it would take to break even in 9 years. And we found that you would need sales of 350,000 per year, which falls in between the base case and the worst case. We'll go into more detail on the cases right now in the base case.
So looking at our base case of our revenues of $360,000 and our opening costs of $438,000 and $350, we have our net present value coming down to 47,113 over the 9 years. Over the 10 years, which we accept because that does bring us value to that is above zero and does bring us value. Looking at the internal rate of return, since our WACC was at 5%, and here we have it at 7.73%, we're going to go ahead and accept it. And then looking at the discounted payback, we have it in at 7.84, which we're going to go ahead and accept as well, as it's earlier than our payback cutoff. And now looking into our best case, we have our total revenue at 419,000 with the same opening costs of the $438,350. And then again, if you want to look at the cost of goods sold, bank service fees, and royalties, we have that all calculated as a percentage of revenue. So this does, we do have higher numbers here on our best case than we did on our base case. So that bringing down to the net present value, we have that in at $337,535, which we're going to go ahead and accept. The internal rate of return is at 22.66%. And then our discounted payback is at 4.58, which we will accept as well.
All right, and then for our worst case, we had the revenue starting at the 301,000 with same opening costs. Same thing with the revenue as a percentage, or the cost of goods sold, bank service fees, and royalties as a percentage of the revenue. And you can notice down on the 14th and 15th line, that is the absolute closest we will ever be to break even. After that 15th period, we just are losing money every single year after that point. So the net present value at this at the time would have been $243,309.87 in the negative, with an internal rate of return of negative 13.26%. And the discounted payback would essentially be infinite, but for the sake of this graph and information, we have it just capped at the 15 that it is here, or the closest it would be to break even. And then for our break even, so this one we found with using the goal seek that our annual sales would have to be starting at $350,428.98. Same things with the cost of goods sold, all that being a percentage of the revenue, which brings our net present value to zero. The internal rate of return equals WACC, which would also be accepted because it does equal, and then our discounted payback ratio is, or our discounted payback period is 9.
Right. So what's your final recommendation?
So for our recommendation, based off of what we spoke to about the franchisee, is if we can get a good manager to come on board at $36,000. Usually, what we want to go ahead and do is we want it to be an internal hire that moves up to the general manager rather than a college graduate, just because the salary is a lot lower than what a college graduate would demand. So if we can go ahead and lower the opportunity cost of not having to be at the store every single day, so where we don't have to commit a lot of our own time to running the shop, and it can just be a a side income, then we do recommend doing the project. But if it is something where we have to dedicate a lot of our time to, then we feel that we can pursue other avenues of higher revenue margins.
All right. Well, I asked another thing about this, so this really is curious to me. So you have someone called a general manager. That sounds pretty impressive, but you're only paying them 36,000. So Jacob, you're saying they're not necessarily a business degree holder.
Correct. Yeah. So just somebody who, could have started off as a team member and then just, went up to a team leader and then eventually a general manager.
Yeah, and these people are out there. I've seen them. I worked in fast food for a month and 1 week. They're the high school grads, don't want to go to college, but they're go-getters. They're enthusiastic. They know that they learn their jobs backwards and forwards. But boy, there's not a lot of them out there, finding them. So, I mean, that's kind of a problem, right, Jacob? You say, if you can find that person, it makes sense. But boy, how do you know if you're going to find that person? And it's probably going to be somebody that you hire and train, which means you're going to be the general manager for a year or two. Every time I see a franchise, labor is the one thing that scares me more than anything else, because I just don't know if you can find good workers. It just seems like it's getting more and more difficult, especially now where there seems to be a shortage of unskilled workers just because of COVID and people are just getting tired. Would that by itself be enough to say just, you said you talked to, Georgie, you said y'all talked to a Baskin Robbins. You get a sense of their frustration with them with labor issues?
Yeah, we did. One of the general manager's daughter is actually one of my friends, and we were asking her about things that she didn't like and things that she did like, and a lot of her stuff was coming from corporate more than it was the frustration of the store itself, if that makes sense.
Well, the other issue I have with labor is the difficulty of it. So of the actual business.
Yeah.
Like when I walk into a Dairy Queen, boy, that's a complicated business. They've got way too many things on the menu. Everything, there's some things that are ice cream versus hamburgers, and everything's different. The training must be horrendous. I would think a Baskin Robbins, the training is probably pretty simple, or not?
Baskin Robbins, typically for customer interactions, you'd see employees just scooping ice cream and operating machines most of the time.
They don't make the ice cream cakes, I assume. That comes from corporate or not? So,
they do make the
do?
cakes. They make and decorate the cakes themselves.
Do they really? Okay, well, that's a little more challenging. Yeah, that's kind of the franchise I'm looking for is, boys, I don't have, if I lose a worker, it's not going to take me six weeks or 2 months to train the next one. Okay, so you're showing income of about 70 to 100,000 a year. Boy, that doesn't sound like much if it's going to be a headache. If I did 5 of these, do the headaches multiply by 5, or is there some economies of scale of doing 5 of them versus doing 1?
Headaches definitely might increase if you're able to find someone that can manage the stores or manage the employees to allow you to be kind of more hands off. Then you wouldn't have as many headaches. But if you're out there, if you're the one that has to deal with each employee that falls through, then it definitely could be an issue on a larger scale. The people that we talked to, they own 2, and they're in the process of trying to shut down one of them because they found one is more profitable, and having the other one there just takes too much time and effort.
Oh, really?
Yeah. So the one that they're shutting down, they've had it for over 10 years. And it's a location issue at this point. The other one that they have that's more profitable is near North Star Mall, which gets a lot more foot traffic than the other one. I forget the exact location of the other one. I think it's in Alamo Heights area.
It's Stone Oak.
Stone Oak.
Mm-hmm.
Yeah. So I think if you were able to just get someone that could do the hiring, managing, and upkeep of the employees, it might allow you to have more of a hands-off overhead instead of.
Yeah, it's all about finding the perfect employee. This is a very labor, you win or lose by your location and your people. Although you mentioned the corporate stuff, I don't know what corporate headaches they're creating. You're a little at their mercy based on what they advertise versus what you want to sell. I haven't seen Baskin Robbins on TV because I don't have a TV, so I don't know what they're pushing. Okay, you mentioned the seasonality of it, which that's kind of a pain with this business. Now, your most aggressive assumption, you a little bit alluded to it, is the 5% labor growth. If your labor is growing at 5% and your revenues are growing 2.5%, obviously this becomes a disaster after 10 or 20 years. As you saw in your worst case, there's just no way. At some point, you're paying your workers way too much. I think the 5% makes sense the next 5 years or so, just because there's a lot of minimum wage discussion, debate. I doubt if general inflation's 2.5%, you're going to see entry-level employees pay go up 5%. 5% is a pretty hefty pay raise for kind of high school kids, a lot of turnovers. So I think you're being a little too conservative there. That's a pretty high inflation. If you'd said 5% for the next 3 or 4 years as minimum wage makes its way, or maybe you have a one-time big bump. I don't know what the typical pay here is. I didn't do 25 divided 12. Yeah, so you're already above 11. They're talking about a $15, I guess a $15 minimum wage. You would have to just raise your prices. You probably wouldn't have much choice in that case, I would assume. And your manager would probably ask for more as well. So yeah, I think in salary inflation is a big deal. It might be more of that it jumps the next couple of years if they do go to a 15% federal number. Though I think a lot of people would just shut down. That might, I don't know, could this business survive? Change your $14,400 to $15 instead of $12. So multiply all that out. Let's see how good your spreadsheet's set up here. Well, no, take 25 times 25
Sorry,
times 12 times 52, right?
25 times 12 times 52.
Right, that's how you got the 14,000, isn't it?
Oh, so for
times 15, 20 times 15 times 52 weeks.
2.
No, something didn't go right. 25 hours times 15 times 52 weeks. 52 weeks. Yeah, there, that makes sense. All right, now look at your base case. See who blows it up. Yeah, that'd be disaster. Well, I tell you what, do that, but go change your employee inflation to 2% instead of 5%. Now see your base case. Just curious. Yeah, I mean that's disaster for this business. I would assume every business like this would just raise their prices. You'd almost have no choice. So $15. So this business, I mean, that's interesting, right? When you get to economics class and they start talking about minimum wage, you'll have something to show them. Baskin Robbins doesn't make sense at $15 an hour. You'd have to really raise your prices. So, okay, that's interesting. So would you actually do this? Is this something you'd actually do? I guess, Jacob, you kind of answered that. You got a lot of ifs. If you can find really good workers, which seemed like a pretty big uncertainty.
Right. I personally wouldn't open up a Baskin Robbins franchise.
Yeah, it's a really big initial cost of capital at $438,000, which I don't have at all. And also it seems like the income just isn't enough yearly to justify all the potential effort that I'll have to put in as an owner.
Yeah, I mean, if you invested that money, you could make pretty well just put it in the stock market or something. You won't make 70,000 a year, but you could probably make 30, 40,000 without any effort. And and then you spend your time doing other things that you could probably make 70. I mean, y'all are already going to make a lot more than 70,000 a year. And this franchise wouldn't be your part-time. You'd probably be spending 30, 40 hours a week. So yes, that's why I say 70,000, man, kind of work. I don't think I'm kind of with y'all. I don't know if it'd be worth it, my time to make 70,000. Y'all will probably make 70,000 right out of school, if not more. And you don't have to deal with sticky fingers and sick employees. All right, good. I can't think of any other questions. I don't see anyone else. Ariana is on the call. I don't know if she has a question.
One more thing I did want to mention, on the assumptions, whenever we were talking about the salary, they don't actually start at $12 an hour. They just found that was their average. They actually start them closer to $10 an hour.
Yeah, okay.
But that was calculating after the raises. So they do actually start much lower than the 12, which would certainly impact, or which actually would benefit the base and best case as well. But we just used 12 because that was the average that they did have for that.
Yeah, so the $15, and that's, I think the issue Congress is going to have with the $15 federal, $15 in California might not mean anything, but in San Antonio, that could probably lose a lot of people their jobs, probably put a lot of small businesses out of business, I would think. I mean, it's something to debate in your economics class and just see. And Ariana, they started with the intangibles, so it was the first thing they did, so you might have missed that first part. All right, interesting. We have several franchises. No one's getting me real excited about starting the franchise. I got to do something when I finish my teaching career. When I hit 70, I doubt I want to open a Baskin Robbins when I'm 70 years old, but interesting. All right, good. Send me your final. Y'all send me your final Excel file. Just email it to me, and I think you're good. Good job. Interesting.
Are we gonna leave the salary per part-time employee and the inflation the same as what you asked for?
Yeah, y'all can switch it back to your assumptions.
All right.
I was just curious, just more scenario analysis. Yes, y'all had 14.4, so y'all are probably starting them a little bit less than $12.
$25 a week at $12 an hour.
And it does help, you had 14.4 just keyed as a number. It does help to actually put the math in a formula like that so that people know what you were assuming. So you might go back and actually see how you got that 14.4. So you know where you got it from. So, okay. All right. Thanks, guys.